Okay, good afternoon, everybody. Thank you all so much for chiming in. I'm going to give about, I don't know, 15, 20, 30 more seconds to let a couple of people who are just now calling in get on the line. Okay, it looks like we're 2 minutes after. So it's so great to see you all. Thank you all so much for attending our final 2022 not-for-profit webinar series here at Anders. We're delighted to bring this series to you this year. Stay tuned for our plans for 2023. Our not-for-profit industry group will be working hard towards developing our program for you for next year. So we've had a couple of good sessions over the past few months. We've had some technical topics and some interesting topics like crypto technology or cryptocurrencies and things like that. So we thought we'd end the year by reaching out across the aisle, so to speak, to some of our colleagues in other departments to look at some of the most important and relevant economic conditions and things that are going on right now for all businesses, not just not-for-profits, but all businesses are kind of having a lot of the same conversations. And so we want to introduce we're going to do a sort of a panel discussion for you today. My name's Jeannie D. I think I've met everyone on the phone over in the audit and assurance department here at Anders. And my colleagues on the panel will be Chris Schrader, who is a wealth advisor over at our sister affiliate company, Claris Advisors. And then also my colleague and friend from here at Anders, Jacques Lebeau, who is in our advisory services department as a director of talent. Our moderators will be from our audit department, Brian Losey, who's a senior manager in audit, and Laura Long, who is a manager in our audit department. Many of you know them from working through a lot of not-for-profit audits. So I'm going to kick it over to them to start working through some questions relevant to investing, investment management, some things in the labor force, and I'll chime in from time to time with some not-for-profit centric comments. So we hope you enjoy the session today. There are going to be 3 polling questions throughout. So for those of you who are on the line to get continuing professional education, we'll ask you to hit the little toggle buttons when those come up. And then we'll get those certificates out to you after the call. So I think we'll start. Brian, I think you're the moderator that's up first.
Great. Thanks, Jeannie. And thank you, everyone, for joining. And I will say, if you have questions, feel free to use the question and answers chat, and we'll be monitoring that throughout the webinar today. So, Chris, 2022 has been a difficult year from an investment standpoint. Do you have suggestions or guidance that you would give non-for-profits about their investments?
I do. Let me recap. You know, I hear a lot from folks. Oh man, this year it's been different. It's an anomaly. There's so much stuff going on. Well, yeah, there's been a lot of stuff going on. Obviously, we're in an inflationary cycle. There's a Russia-Ukraine war. We've seen oil prices rise and come back. Food prices have soared globally. The lockdown in China with the COVID policy has impacted, both higher prices and delays in our supply chain in some respects. And something of note, 2 years ago, or the 2-year Treasury, roughly a year ago, was at 0.63 basis points, and today it's at 4.34. Now that's as of a couple days ago. It obviously changes daily, but that just gives you the impact of what's happened with the Fed using one of their levers to work on the inflation that we have. And the 10-year, which is one of the most notable, a year ago was at 1.43, and it's at 3.52 as of a couple days ago. So this, the Fed ramping up these yields, or what's known as tightening the Fed funds to help ease inflation. The inflation number in June was 9.1, and it's come down to 7.7. And we go back to January of 2021, that number was 1.4. So you can see that certainly has risen. And then, of course, that has stock market volatility, and that's what most folks are interested in, or they're talking about, or they hear on the television or from their friends at holiday parties and such. So here's what I would suggest. Don't panic. All right. And if you remember anything, it's Chris's 3 R's. Remain invested, review your asset allocation, and then reallocate where necessary, because markets that are volatile or moving up and down present us with opportunities to realign our portfolios because they tend to move out of balance during these times. So we want to revisit those portfolios to make sure that they're doing what they need to do. Because 90% of returns, Ibbotson says 90% of returns are due to our allocation. Okay, so we want to buy low and we want to sell high. So that was it. Remain invested, review asset allocation, and reallocate where necessary.
Thanks, Chris. I know we're all looking to put 2022 behind us. What's the investment landscape look like for 2023?
I think it depends on who you read. So I've been reading my friends from JP Morgan and Vanguard and Goldman Sachs. Those are pretty much household names. And then a partner of ours, Dimensional Fund Advisors. So let me start with what the St. Louis Fed has said, and it'll be brief. And it's hard for someone that is consider himself a bit of an economist to be brief, as you remember from your college days. But the outlook for the economy in 2023 has dimmed over the past year, and I've kind of stated why. So, but what they feel here is that the unemployment rate will average about 3.6%. And excuse me, I'm reading just kind of from the screen. And in 2023, that real GDP is going to increase by 0.8%, and the unemployment rate should move up to about 4.2. So still, unless you're impacted, by the unemployment rate or you're out of work, 4.2 is still within that range of the Fed's mandate, which is really price stability, which is controlling inflation, and then of course maintaining full employment, which generally is in that 3 to 4% range, to be fair. JP Morgan has some pretty positive long-term capital market assumptions. And I like that because really we should be in more of a long-term mindset. Whether or not we move into a recession, they don't last long. And if we do, they don't anticipate a recession 2023 to be at anything of an historic proportion. Okay. So the most rosy that I found, so I don't bum everybody out during the holiday season, is Goldman Sachs is really talking about a soft landing. Now, what that means in a soft landing is, we've brought inflation back down and we aren't in a recessionary environment. Okay. When you hear the term hard landing, and Vanguard really talks about all three. These are the things that could happen versus this is what we think. But, an economic slowdown or the downturn, and that generally follows a period of rapid growth, which we've had. Okay. And the hard landing is exactly what it sounds like. We hit hard and the economy has inflation and it has unemployment. I don't think anybody's really saying we'll move into what's known as a stagflation for 2023, and that's really high inflation and high unemployment. Okay. So that being said, positive growth earnings in the coming quarters. We'll see an increase in real disposable income. We'll see some more rate hikes. Sure. I don't think anybody doubts that. But expect more rate hikes that help keep growth below potential, but the continued focus on rebalancing the labor markets. And I know Jack will talk a little bit about that. So those are the couple of things, Brian, that I see.
Thanks, Chris, for providing that landscape for 2023. I did want to kick it over to Jeannie. Jeannie, do you have any insights to what charitable giving is going to look like?
Yeah, thanks, Brian, and thanks, Chris. Everything sort of dovetails into maybe more of a, for our not-for-profit friends on the phone, what is that going to translate into? There's growing, I think, I won't say anxiety, but maybe a little bit of nervousness about what does all this mean with respect to what charitable giving could entail next year. And I think just looking back, fortunately, we had a record charitable giving year in the United States in 2020, despite the pandemic. Now, maybe the circumstances were that people were feeling very, very generous and they didn't want our not-for-profits to suffer because of the chaos that was going on at that time. But we had around $470 billion with a B dollars in total charitable giving in 2020. That was a record year for the United States, throughout history. And then it went up in 2021, up to almost 485 billion. That's about a 4% increase. Now, argue that increase, when you adjust it back for inflation, maybe it was a little more flat, but nevertheless, dollar for dollar, still went in the right direction. And in that same time frame, individual donations the number of individual donors continues to come down a little bit. However, the percentage of charitable giving done by individuals continues to stay the same. So fewer people are continuing to give more money. The breakdown in the United States, and this hasn't changed dramatically over time, but it's been about 68, 69% has been from individual giving. And then we have another 19, 20% from foundations, 9 or 10% from bequests, and just 2 or 4% from corporate giving. So we're excited that while the number of individual donors is shrinking a little bit, that just could be some demographics at play, that the percentage is staying very, very strong. It is a concern, though. What will that mean if people are nervous about the markets? Chris mentioned stock market volatility. There's some information about the reasons that especially high net worth donors give, and there was a study done by BNY Mellon just this past year on the motivating factors for high net worth individuals to give, and tax planning ain't one of them. I mean, it's very, very low on the list. They give, for feelings of, wanting to support their community, wanting to give back, so to speak. So the reasons that those donors are giving is not going to be as dramatically impacted by the volatility that we're seeing, at least in that group of donors. There is also some guidance out there that's emphasizing corporate giving a little bit more and more. And that's probably what Jacques' going to get into here in a moment with the shifting of the labor force. People want to work for companies that are engaged in their communities and are charitable. And so this maybe as a development tactic, maybe pushing more on the corporate giving side, we think that could be an uptick. So I don't really know what it all means when you add it up, but there may be some shifting there, but it's not as doom and gloom as I originally thought when I started looking into this. Oh, I'm sorry. Forgot about the. Oh, I thought we had a polling question. No, we don't. I'm sorry. Keep going, Laura. Sorry.
I was gonna say maybe we do. All right, that kind of takes us to our next point. So, Jacques, what does 2023 and 2024 look like in terms of labor in the economy?
Yeah. Anytime you're forecasting what's going to happen next year and the year after, obviously, you kind of have to hedge your bets a little bit. But I think it all mixes in together. Everything's kind of intertwined. So what Chris talked about in terms of unemployment ticking up, I think is probably a likelihood. We're already starting to see some signs of that with some layoffs. That tends to be, at least so far, it tends to be the larger corporations that have more people, which makes more sense. If you have an entire department of people doing something versus a couple of people doing something within a company, it's easier to shed some of those folks along the way. So they tend to kind of breathe in and breathe out people when you think of the larger corporations versus the smaller. A lot of it depends on where the economy goes from here. There's been a lot of talk of whether we're headed to recession, not going to have recession, the hard landing, the soft landing. All of those are pieces that I think it all depends on what happens from here in those areas as to how that will directly or indirectly affect labor.
What is the job market like today?
Today, it's still messy, for sure. Anybody who's tried to hire somebody, people on the call today, if you've tried to hire, it's challenging for sure. It's the tightest labor market that I've seen in 25 years, and it probably will stay tight regardless of the layoffs or the potential economic concerns. And a lot of that has to do with, growing up, I always heard about the baby boomer generation. Well, now we're right kind of in the beginning or the first quartile of the baby boomers retiring. So there's a lot more to go, and that will have an effect for years to come. At the other end of the funnel, you have fewer people coming in than there are going out. So just supply and demand, back to the economist side, that means that you'll have a shortage of people. So the race is kind of what can be automated versus what, so technological advances will shed some people, and the labor markets will kind of adjust to that. But today it's tight, and even with some layoffs, I think the market can withstand that, so it will remain tight for the foreseeable future, I would say.
Thank you, Jacques.
I'll chime in real quick, Laura, because I wanted to bring something home with respect to what Jacques was talking about. It wouldn't be, you guys, you know me, I'm not going to get through an entire session without talking about functional expense reporting at some point too, because it's been, the hottest topic. But everything that Jacques just said reminds me to remind you that hey, once a year, we'll take a look at our functional expense allocations, and then we'll just live with that for you. Those days are over, guys. We really, you have people in your organizations moving assignments, changing what they're doing and how they're doing it, probably more frequently than ever before, or at least in the past, I don't know, 20 years or so, right, Jacques? So it's really incumbent to look at what they're doing, what their activities really are, to see how it's related to your programs versus your management and overhead. That's the biggest number that gets allocated for most of you, is that salaries line, that salaries and employee expense line. So we really want to keep an eye on that as you've got open positions in your organizations you're trying to fill. So maybe you've got people doing double duty and changing their roles quite a bit. We do not have any current data as a result of the pandemic on the overall shifts on functional expense reporting. I suspect it'll be changing pretty big with remote workforce, stuff like that. But that data is just not at the IRS yet. So hopefully in the next year or so, some of that will come out and we'll start to see some real numbers in terms of new benchmarks. But it's my healthy reminder to you all to be looking at that more frequently than ever before. Okay, so now we're at the polling question. Sorry about that, Laura. So I think somebody from our group will launch. Oh, there it goes. And so is the idea of a recession something your organization has concerns about? I take a look at how this works, and okay, numbers are still coming up. I don't know if you all can see this, but yeah, 80% are thinking this is something we want to talk more about. We have some concerns. That's probably not surprising. So we will keep going. Thank you all for chiming in on that. I think it's back to Brian.
Yeah, and that kind of takes us to our next question for Chris. Chris, you and Jacques both have kind of talked about inflation and recessions and everything. Is this something that we should be worried about? Should we be worried about continuing inflation and a recession coming up?
Well, the short answer is no, I don't think we should worry about it. I think we have other pressing matters in our day-to-day lives that we should be focused on. But I do think it's good to be educated and to understand where it fits into the context of our economy, and then obviously then how it does impact our business and our employees. But whether we move into a recession or not, the bottom line is mild or whether it's mild or significant, it really matters little to those that are affected. So I want to just make sure I couch my comments around that it's still something that impacts people that we know and we care about. So there's that piece of it. But the reality is these are normal business cycles, and they feel bad when we're in them. But right now, we don't even fully know if we're in a recession yet. So that way, it's really good headline risk, and people like to talk about it. So I think we need to back up and take a look at really where we are. Vanguard says that the unemployment is likely to rise. Jacques and I kind of alluded to that. And it's going to rise over the next year, but it's going to be nowhere where we were in 2008 and 2009. Okay, so to put it in context, nobody is forecasting that whatsoever. And because the unemployment is still pretty solid. I mean, even it goes to 4.2 or bumps up against 5, that's still, Jacques, you'd agree, still pretty reasonable. Okay, so and we'll continue to see a downward trend in inflation in 2023, through the Fed's action. So I would say be aware of it, but certainly I don't know from a long-term perspective. All right, and long-term can be, anything you want to define it. I generally say it's 3 to 5 to 7 years at least. And a lot of our business, particularly in not-for-profits, are built almost in perpetuity to a certain impact. So these are things we're going to experience. We'll see them again. Maybe in a call in 10 years, we'll be having the same kind of call. But these are normal business cycles. And we entrench, we grow, we fall back, and we move on. So something else that I want to make sure is that a little bit of a misnomer, but just because we're in an inflationary period right now, that doesn't mean it's bad news for stocks. All right, and that almost seems counterintuitive, but the economy and the stock market are clearly two different things. So a study by our partners at Dimensional Fund Advisors, they don't show any reliable connection between periods of high and low inflation and U.S. stock returns. All right. So if that gives you some comfort, which I think it should. And, we know since 1992, 1-year returns on stocks have fluctuated wildly. The weakest returns have occurred when inflation is low. And in 23 of the past 30 years, we saw positive returns even after that inflation has been adjusted. Now, the S&P posted an average annualized return of 8.1% after inflation adjustment, and our U.S. stocks 7.3 after inflation adjustment, going back to 1926. So my point is stocks can outpace inflation over time. Hence, why you hear your advisor saying, stay the course, don't make any moves that aren't required for another reason. All right. And then go back to Chris's 3 R's: remain invested, review asset allocation, and then reallocate where necessary. So those are my best thoughts on that.
Thanks, Chris. And like you said, when we're in the current kind of cycle, that's a good time for people to be reviewing their investment policies. What are some of the considerations they should be looking at when they're looking at their investment policy statement, given the market right now?
Sure. Well, at a minimum, and Jeannie, you may agree with this, but I've served on a number of nonprofit boards. I always advocate at a minimum, take a look at your investment assets. If you have them pooled, if they're unrestricted, restricted, take a look at your objectives for the coming year. Whether you have an investment policy committee, like a finance or an audit committee that looks at this on a regular basis, look at it annually. And your investment policy statement really should be in alignment with your goals, short-term and long-term. All right. And whether this is for your business and your business is a not-for-profit is that, or it's for your personal household, this is a great time to take a look and see where you are in terms of do we need to rebalance? What do we have in our portfolio that we understand that we don't understand? The folks that get hurt through these downturns generally have investments in their portfolio that aren't appropriate and really aren't really there to help them in terms of their longer term goals. So I would say that it is without a doubt one of the most important things you can do at a minimum annually to revisit your IPS and go out for a second opinion if necessary. Work with a professional like Jeannie, or you can call me and say, would you review our investment policy statement? And we'll have a conversation around goals, objectives, and your mission. And that's really what we want to stay focused on.
So do you think organizations should change their asset allocations now?
If it's in an alignment with their goals. Okay. I don't see a reason to change it because based on the market. And as I mentioned, markets and the economy are two different animals. So if we believe in history and we know that the average recession is roughly 14 months, we don't want to make adjustments because of where we are in the market today, but we do want to thoughtfully look at our portfolios in alignment with our goals and objectives for next year and the year after. All right. And do we need to make a change? I'll preface that by saying what I have seen from nonprofits is they, towards the end of the year, they get donations all year long, but this becomes giving season in December, and they'll have an influx of cash and other maybe non-monetary items for donations. And so that's a good time to really begin to think about what else should we be doing with those particular types of investments that are coming in, and how will they be spent? And then where do they fit within my investment portfolio? So I go back to, like a broken record, change it when it's in alignment with goals and objectives, not necessarily because of what the market's doing. Okay.
Thanks, Chris. That kind of actually takes me into my next question, which is how can organizations, and this is especially, pressing for non-for-profits looking to get some sort of stable income, how can they create stable income for their non-for-profit?
So I'm going to break this into two parts. The first is, looking at, how do we build assets? Are we heavy in cash? What are some of the things we should do just from the management, of our investments in our cash that's in our non-for-profit? It's not all bad news when we move into an inflationary environment, because there's always another side to the trade. And right now, what that is our yields on our fixed income have gone up. And I mentioned that in terms of treasuries, but so have CDs, so have other types of traditional fixed income investments have moved up. I always hate to quote yields because they change, but we certainly are seeing certificate of deposit rates and yields have moved up. So here's a place when you have money coming in, whether it's restricted or unrestricted, to take a look at having a conversation, say, with your bank. Are you maximizing, their sweep rates? Do they have you in the right product right now to take liquid cash you need on a daily basis, or regular, liquidity? And are you getting the highest rate that they can offer? Don't be afraid to have that conversation with the bank. Also, if you have 1, 2, or 3-year monies that are deemed for a project, you can work with an investment professional to maximize the return based upon the fixed income market, and provide you actually with some guarantees, which are rare to speak about, but treasuries and certificates of deposit done the right way bring with them some safety and some guarantees that you don't find with other types of investments. So, that's one place to go. So that's on the kind of the balance sheet side. I was going to have a little fun with some of this in terms of the income side. And I've worked for, and when I was a youth group leader, we visited a furniture bank in Minnesota. And if anybody wants a name, they can shoot me an email or get in touch with Jeannie, and I'll share more with you. But they were a furniture bank that worked with agencies, not direct clients. And they had a furniture shop. And so one of their income generating ideas, which I thought was pretty unique, is they invited groups in. And Minnesota has a ton of, 3M and some other very well-known industries. And, their groups are always looking for project work. So they would come in and they would build dresser drawers. They would build other items. They would repair furniture. And for that, there was a donation made, but also they sold these products too. So the furniture bank either utilized them with their clients, or they were able to sell some of this furniture, repaired furniture too, to draw some additional income. So it was in line with their mission. So it probably didn't create Jeannie heartburn with what they were doing. But again, I just thought it was kind of unique because it didn't dawn on me they have this whole furniture shop. So, some of the other things I've read about and I've thought about, to create an ongoing income, and some of this may be new for our friends on the phone. For others, it may not be, but get a little creative in some of the things I've read. Selling merchandise, branding yourself and selling shirts and caps and scarves, and, maybe finding another corporate partner, to help you along with that, to offset some costs. But this continued branding is very important, to the mission of what it is that you do, whether you're large or you're small. I saw something that was unique in one of the articles I read about holding an art show. That seems like a lot of work. But again, if you're receiving items that are being donated in, and maybe you're getting art and some other type of non-monetary assets, then maybe that's something that you could look at doing. There's always the charity auctions, raffles, trivia nights and scavenger hunts and things of that nature. But here's another unique one that I thought was kind of cool. Where I live, there's a nonprofit, and they put on a taste of an event every year. They've expanded this now in their mission, and they actually now have a full bakery where community members can come in, bake their own goods, utilizing, the facilities there, and then donate those items to the nonprofit. And they have a regular bake shop where you can walk in and buy gluten-free bread, for celiacs and gluten-free folks, all different types of things. It changes, and it's been extremely successful. Again, sounds like a lot of work. However, when you're inviting community members in and they're utilizing your facilities, it offsets a lot of the costs and a lot of the cleaning. So the other thing that I noticed, I've served with a lot of folks that are, just incredible people. So your board members, look to your board members and ask them what are some of their additional causes, what are some of their skills, and leverage that to looking to partner. They have experts, maybe spotlight one of those members, and even look to hold training sessions, with these on other industries, and for a suggested donation to come and listen to this individual talk. So get creative. I mean, I think that's one of the things that you think about, and work with your professionals to make sure it's either in line, or if it's not quite in line with your mission, how that's going to impact you. But again, the furniture bank was really cool. This bakery, I thought is fantastic. Renting out space, if you've got a large facility, being able to rent out the space for community room meetings and small events, going back and re-engaging with your donors. I agree with Jeannie. We don't necessarily see a drop off of donations based upon the type of environment we're in. People give for the same reasons when things are good as when they're not so good. And then last but not least, we did a lot of fundraisers. I know there's some stuff through Amazon Smile and some other programs that are really all year long that you can register with. So just, I didn't want to kind of bum everybody out with the economic news, but I just wanted to bring up a few extra ideas, and maybe one of them there's resonated. So and I'd be interested to hear more as I serve on some nonprofits myself as a board member. So I will stop there.
Thanks, Chris. And I think one kind of note there is, as we're looking at these other revenue streams, some of the heartburn, I think, that you mentioned comes from unrelated business income and the tax on that. So Jeannie, do you have any considerations there?
He called it the Jeannie heartburn, though. So I don't know if everybody caught that. It's not really my heartburn.
Yeah, trademark, patent pending. Trademark
pending. Okay, the Jeannie heartburn. So it's I actually don't have a problem with unrelated business income. I think you should do it. It can't take over your operations, right? But I do get a lot of phone calls from a lot of organizations, a lot of clients saying, "Hey, we have this cool idea for this furniture bank thing that Chris brought up, but we're a little nervous that it doesn't fit with our mission. So what's that going to mean come tax time? Are we going to have to pay the bill?" And it's a valid concern. It's something you do need to think about. As accountants, I will tell you all, when it comes to unrelated business income, it's just a matter of record keeping for the most part. Obviously, we can't let these things take over your entire operations. There's some metrics on that. We have to watch it. We just need to be aware of what is the activity. The rules are actually fairly clear. It's an ongoing business activity held regularly conducted, meaning your one-off golf tournaments and your special events and your galas and all those are off the table. Those are off the table by statute with the Internal Revenue Service. But if we're going to have merchandise sales, if we're going to do advertising, as you all know, is kind of that's the lowest hanging fruit of all of them, advertising in certain newsletters and things like that. The third criteria, though, it's not substantially related to our mission, or it doesn't have that educational component, that mission component, and that's in the eye of the beholder sometimes. So we really have to look at what you're doing. Is it competing with a for-profit business? Is it regularly conducted? Sometimes we err on the side of being conservative. You can't answer all of those questions in the positive, or I guess in the negative. We're erring on the side of being conservative and saying, all right, let's go ahead and track it. Let's also track all the expenses that we have against it. Because at the end of the day, it's an income tax, meaning it's net income, revenues minus the expenses. A lot of times we can get that number down to very little. Oh, and by the way, you're not going to pay 100% in tax. You're only going to pay at the corporate rate. So it might reach more people and have a lot of intangible impact because, again, you can reach new donors, reach new constituents. There's nothing wrong with engaging in an activity like that. It's just you got to do the paperwork right. And if we're not your accountants, then talk to your accountants about how do we get the paperwork right on this so we stay out of trouble with the IRS. That's really all I need to say about it. And I think that brings us to another polling question. I think it does. Is your organization currently facing challenges with employment? I'm going to answer for us. Okay, so we're at about 2/3. That's probably it's tweaking up just a little bit. That's not unexpected. That's from talking with many of you. That's well, I guess Jacques might tell us here in a second if you all are a mirror image of what's going on globally. Okay, Laura, I think you're up.
All right, Jacques, where have all the workers gone?
Yeah, that's the $1 million question, right? Everybody feels like there just aren't enough people. I don't know that the number of people has changed that dramatically. It's just that you have a market that's very candidate imbalanced, meaning they hold the power right now. There are more openings than there are people to fill the openings, and it's rare that that's ever in equilibrium. Usually it sways one way or another, but not this extremely. So there have been times, if you go back to the last recession, the Great Recession, somebody that's been with the company for 15, 20, 30 years is leaving the organization. And then it kind of reshuffles the deck there again. Do we need 2 people to replace that person? Do we need 1? So I don't know that all of a sudden, aliens came down and abducted millions of people. I think there's still a lot of workers out there and a lot of candidates out there. It's just their mindset's a little bit different. And so they may not be answering postings. They may not be interested in looking at a particular industry or a particular opportunity unless it meets the things on their wish list to look.
How has remote work and return to office initiatives affected the hiring market, would you say?
It's changed it dramatically. And I think the jury's still out on how everything will settle ultimately. But we've already seen a little bit of a resurgence of companies saying, we want you back in the office. And then you've seen other companies who have kind of gone the other direction and said, we're going to give up our space. And this remote thing has worked pretty well. And we're going to, kind of let the space go and let people remain remote. Who knows what the right answer will ultimately end up being and where everybody will settle. A lot of people say, well, something in the middle is kind of a middle ground. It's like straddling the fence a little bit and giving some of that flexibility, but not giving it all away and having somebody remote. So it's changed things dramatically, and it certainly has changed from a recruiting standpoint. A number of the positions that I've worked on that have been a little bit more challenging to find candidates for are the ones where they demand the person in the office 100% of the time. Candidates, may be open to the location, the pay is good, it's an industry that they have experience in or they're interested in, but they just can't let go of that idea of flexible work or working remotely. It's also dramatically changed the candidate pool in various markets, because if you're going to work remote, you can work remote for a company in California or Boston or Miami, and those coastal cities have definitely tried to take advantage of the lower cost of labor in the middle part of the country, and they've been doing recruiting here, and the salaries are a cut from what they would pay on the coasts, but still higher than what the local market is, and you can see how that would affect if you're trying to hire and compete with those companies. Your salary range may not be able to reach what they're offering, even though it's a cut for them versus what they would hire candidates for on either the East or West Coast. So it's really changed things pretty dramatically.
Speaking of those coastal comments that you made, how do you think salary and benefits have changed the landscape of hiring?
For candidates, it's been wonderful, right? You can ask for the world and you can get it. I've seen some people and have placed some people in positions where I thought the salary that they were offered was crazy. And it's just kind of a function of where the market is. Now, is that sustainable? Absolutely not. So, when we talk about a recessionary time, and there will be one, whether it's coming now or whether it's coming down the road, that's kind of a reset in the market. And companies will look at their expenses. People are the biggest expense in almost every organization, and they will start to say, who is overpaid? Who did we pay too much for? Could we find that function and pay less in the market for it? So I think you'll see some of those things reset as we have some layoffs, and some of that is probably actually good for the markets. It's certainly going to be a welcome change for organizations that are overpaying for talent right now, and busting their budget in that regard. As far as benefits go, the new negotiation piece of benefits is that hybrid or remote work environment, and that flexibility. That's kind of the new 401k match, if you will. So as that happens, you have to be nimble as an organization, and you have to be able to figure out where you can bend and where you can't. And if it's something that is worthwhile to bend on, knowing that if you make an exception for a new hire, that you probably have a line of people waiting outside your office who want the same thing, the same concessions. So for a lot of companies, they've been soul searching and saying, we'd like to do something, but the type of organization that we are, we have a production component, or we have, a warehousing component where we can't have those people work remotely. So how do we create some level of equity that we're giving all of these people the freedom and the flexibility, and these people can't take advantage of that? So those are all discussions that I hear kind of on a daily basis from different companies, and it's challenging for sure. There's not one answer that is kind of the silver bullet that is an answer for everything. And so companies are looking at it individually and saying what works for us, what can work for us, and kind of making those adjustments as they go.
Thanks, Jacques. And I think as our organizations are paying more in salaries and benefits, costs are really something that they're looking at. So my question to Chris is, how do costs matter to our investment allocations?
Well, costs matter, I think, in any business. And so, to be prudent or, a fiduciary of monies that are bestowed upon us by our donors, we have to be in tune with our costs, and they're important. But as some of you know, my son's in the Navy, and one of the things that he taught me that I didn't learn was we have to control the controllables. He's a helicopter pilot. And if you know anything about helicopters, it's 10,000 pieces of machinery that's not supposed to work together. So their training is based around control what you can control. So I've taken that to heart when I talk with clients. And one of the things we can control, to your point, Brian, is cost. And there are usually two costs, and in portfolio allocations, investments can be delivered by a myriad. We have tons of choices of who we can talk with, but the costs can really fluctuate from one provider to another, and so you have to understand what is it you're getting for that. So there's an external cost, and that's generally a fee. You hire someone to manage that portfolio for you, and then there's internal costs for the funds that you hold. So you want to understand those, and it's always good on that annual review at a minimum, making sure you understand that. The lowest cost provider doesn't mean they're the best. So, let's be fair, okay? But just make sure that you understand what you're getting. Are you getting the communication? Are you getting, the response or the service? Do they coordinate well with your other providers in that respect, okay? And so I think that's important, and I would just point that out as if you have an investment committee or just your board of directors that reviews this. And if you have questions around costs, those are things that a lot of folks, including us at Claris, can kind of help you dig into and kind of put a spotlight on. This is where they are, and this is what it is that you're paying. Okay, so we can control costs. We can control our investment allocation, as I've talked about. Okay, so I won't belabor that again. The last thing we can control really is, again, in these portfolios, is our time frame, because each time a shift in a portfolio is made, there are some costs in that. So we want to be, again, thoughtful as we look to reallocate. What are we doing it for and why? So I would say, yeah, costs matter. Are they the most important thing? No, your mission's the most important thing. The money just helps you achieve that. So I think we want to be thoughtful around those costs in that manner. So I think it's good to explore them and just to understand them, but nothing is free. So there is a cost to those portfolios when they're managed. Okay.
Thanks, Chris. And then finally, to kind of switch gears here for our last question. Our not-for-profit organizations, they get restricted gifts, they get unrestricted gifts. Should they be investing these differently, the same?
Well, I think the answer is it depends, right? So I wanted to point out something, though, that there's some folklore in investing that a young student asked John Morgan of JP Morgan a question, and they said, Mr. Morgan, what do you think will happen in the stock market? And Mr. Morgan looked at the student very sternly and said, I think it'll fluctuate. Okay. And so I think we want to take that in mind when we take a look at our unrestricted and restricted funds. If you're an organization that has both, and your restricted funds, there are certain things that you're being asked to do with them. All right. It depends upon what it is that the objective of that fund is for. Okay. Is it going to pay out quickly? Or is it really there truly in perpetuity, where you're trying to take the interest and the income off of that to fund that mission? So there are strategies to look at that allocation, and that's one of the things that we can control as well. So taking outside the fluctuations of the market, we can actually, get rid of some of the systemic risk by how we do the allocation. All right. I'd answer it the same way also then for unrestricted. Again, the use of unrestricted funds is generally somewhat different, right? A different part of the balance sheet for the organization. But again, if there is some longer term cash there for reserves, for emergencies, if there's a shortfall maybe in a campaign and that makes up that shortfall, if it's allowed, then yeah, you want to probably look at that bucket a little bit differently. So maybe you shorten that up with just, one of the ideas I talked a little bit about on the income side. And so, yeah, I think you'll see, I know the boards that I've served on, there are 2 or 3 or maybe even 4 kind of pooled investments, and each one has a different objective. But it usually is because of the allocation and not necessarily the investments that make up that allocation. So that's really what the point I want to drive home is, yeah, it depends, but it can be the same investments. They can be just different investment allocations. And that helps you kind of control cost, which is one of the things that I mentioned that's important to understand. So I hope that helps. And just remember, what I think the market's going to do today and tomorrow is it's going to fluctuate. Okay, so there you go.
Thanks, Chris. And Jeannie, can you maybe just provide some insights on what donors expect when they're giving their restricted funds?
Right. So thanks, Brian. I echo everything Chris was just saying, even though I don't have his expertise necessarily on the investment side. As auditors and as outside accountants, and certainly as advisors, I mean, we care first and foremost, did the donor put true restrictions, and what do those restrictions look like? Are they restricting the corpus? Are they restricting the earnings? And especially when we're talking about endowment funds, obviously we have this is beyond accountants, okay, but this goes into some legal realms here with UPMIFA, the Uniform Prudent Management of Institutional Funds Act. And if you guys can't sleep some night, you should Google that, take a read of it. And blame the lawyers for bringing this to us, but it really is, those are the donor has the power in those circumstances to drive what their expectations are, down to down to whether or not you can use the earnings, whether or not you can use the interest, et cetera, et cetera. Or maybe it's temporarily restricted for something. But nevertheless, once you're free of that, we love the gifts no matter what. I always tell organizations, don't worry about a donor restricted gift. It's a great thing to have. It'll add to your balance sheet. It'll add to your overall position. That's what you want. It'll grow your organization in size, and it can be a sort of a legacy fund for you. So it's not a bad thing to have. Obviously, development people always want to try to get it unrestricted, so that we can use it in operations. But once it's unrestricted, it's free and clear. And then we're sort of back to where Chris was with designing maybe board policies or reserve policies or internal policies around those unrestricted funds that are flexible, that can morph in and out depending on the circumstances, that you can meet with your advisor once a year and talk about, okay, how can we position this reserve balance for this particular project? And all those decisions can be made internally. So we care first and foremost if we've got those donor restrictions, obviously, because there's some laws in place that need us. And donors, you don't want to get caught violating those restrictions. That's a big problem in not-for-profits. So I think with that's kind of the do's and don'ts at a surface level. But outside of that, we also wanted to make one point. When we talk as auditors and accountants about restrictions, we're talking about an equity concept more so than just the asset itself under generally accepted accounting principles is not actually what's restricted. It's the net asset balance of that we're more careful about. So as long as there's not anything explicitly restricting the asset, it's maybe this is a technical nerdy thing, but it's important to us to always kind of watch the fund balance portion of it. So, but we do pair that up with your investment policies and things like that. Actually, we're at our time now, so we have one more polling question for you all. And I think we're almost ready to wrap it up. Oh, sorry, go ahead, Brian.
No, I was just going to say we had a question in the chat, and if you have other questions, feel free to send them in. Since we kind of ran out of time, we can always reach out and we'll respond directly.
That's a great idea. I appreciate that. I'm going to put a little thing in here that I did. If you had something that you can take back to your organization today, hopefully, oh, that's beautiful. Look at that, 100%. Then our job is done. You guys, we really appreciate the opportunity to talk with you. We're hopeful that you get some benefit out of these sessions. As I said, thank you to our team here, to Brian and to Laura and to Chris and to Jacques, and to our admin and marketing staff that are kind of behind the scenes making all this technology work for us. You guys are awesome. We're gonna regroup in our office over the next couple weeks and the next month or so and determine what kind of programming we're going to provide next year. So I wish you all a really happy holiday season and stay tuned. Thank you all again.
Thank you.
Thank you.